Good morning and welcome. I'm Ben Ormsby and I'm the Yorkshire editor of thebusinessdesk.com and host of this webinar in partnership with Clearwater International. So the last, 2 years, 20 months have been marred by uncertainty and challenge. But as we move to a post-pandemic rather than post-COVID world, what are the long COVID implications for the deals market in Yorkshire and beyond? Well, hopefully over the next 45 minutes or so, our expert panel will be able to give you some ideas as to those implications. But before we start, just some very minor housekeeping. Mainly, if you'd like to ask any questions, please do so using the Q&A function on the right of your screen, hopefully, and I will put those to the panel. Anyway, without further ado, may I ask the panel to introduce themselves and give a brief answer to this question. As I said, the last 20 months has been a turbulent time economically. As we continue to move forwards, what trends have you seen in the market? And I'm going to start, at the top of my screen. So Paul, you're the first person to give the answer, please.
Thanks for that, Ben. Morning, and thanks to Clearwater as well for the invite on this. So just quick introduction. I'm for those who don't know me, I'm Paul Mann. I'm a corporate partner at Squires. I've been here my entire career, and I also head our national private equity group. So morning to all. Wow, Ben, I think 20 months has been a very long time, right? I think we walked into this, or we kind of came into it March last year, probably not quite sure where the next deal was coming from, and I suspect quite a lot of people in a lot of businesses very worried about the long-term effects. I think what's followed, or at least probably 3 months, 4 months after that March 2020 date, has been kind of unprecedented levels of demand, activity, competitiveness, burnout, fatigue, etc. And obviously that's driven by positivity, not negativity. I often look back and think, I'm not saying we could have predicted this. What's driven that activity? If you drill down, I always look at a few things, I think, and Dan, I'm sure, can comment on this, but I think there is record levels of dry powder out there. It's well documented, and I think a number of funds and sources of funding probably had 6 months where it was more an internal review than an external ability to spend. So it felt as though when we came out of the summer last year, there was pent up frustration and a lot of hunger to get out there in the deal market again, which has driven a lot of activity. Obviously, the continual impending tax changes or otherwise, particularly from a capital gains tax, and I think the grey hairs people could see on the side of my head have largely arisen from the deal run into March this year. That drove a huge amount of activity, and obviously there weren't any changes, but that hasn't gone away and continues to drive us to kind of half-year budgets and full-year budgets. And I think one thing that I think sometimes is underplayed a little bit, particularly in the more SME market, is I think people have maybe changed their view on the world, having been through what we've been through. So if as a husband and wife shareholder or a family shareholder, you've always wanted 10 million, having lived through what you may have lived through, you may say, well, I'll take 8 million now with a bit of an earn out, and I'll spend a bit more time in France or Spain or whatever it may be. So I think people's priorities have changed a little bit, actually, which has led to a little bit more deal flow, and certainly for entrepreneurial clients and companies, it's led to more activity. Ben, I'll let the guy. There's obviously been some sectors that have driven that, which I'll let the guys pick up on rather than taking the whole thing. But that's my overview of the last kind of 20 months or so.
That was fairly brief. Well done, Paul. So same question and request for an introduction to you, Dan, if that's okay.
Morning, everybody. Thanks for having me. So I'm Dan Smith. I'm a director at LDC, which is private equity arm of Lloyds Banking Group. I run our team here in Yorkshire. In terms of what we've seen, I think I echo a lot of Paul's sentiments really there. I think the sort of the initial pandemic was such an unprecedented shock for everybody. But once we got through those sort of first 3 months of lockdown, and actually we sort of saw some of the success of some of the government measures, whether it was sort of furlough or CBILS, and actually the economy was probably a lot more resilient than what a lot of people necessarily assumed. I think when we first started to emerge from that period, I think there was a bit of a flight to quality initially. So I think you saw, those sectors which were probably perceived as being most resilient, whether it's sort of technology businesses or healthcare business, there was a real sort of drive towards seeking opportunities there, which were probably seen as a bit of a safe haven. But actually, as we then sort of emerged even from that sort of first few months, I think actually there's been a lot more confidence spread much more widely across sectors and across the economy. And you've sort of seen lots of investment in right across the market. I do agree. I think there's been a little bit of a perfect storm, probably from a bit of pent-up demand from investors. I think you've had lots of people, reprioritizing their own personal objectives, and some of it maybe, as Paul said, people, privately owned business owners looking to de-risk the personal circumstances, but also maybe look, there's an opportunity here. I want to get on and make some decisions and drive some growth, and I think that's perhaps brought forward some of the decision making. And then you've got the ongoing merry-go-round of the sort of tax piece as well thrown in there. So I think it has been a bit of a perfect storm. But if you'd have given us that option, back in March last year, I think we'd all grabbed that. So I think there's lots to be really kind of grateful for. And as we sort of look ahead, I think there's also lots of optimism. So I think that's probably going to be a fairly sort of consistent theme as we go throughout this conversation, really.
That's always a good sign. Although optimism never sells newspapers, which is just a that's
your job, then.
A little bit of fear mongering wouldn't go amiss. On to you, Richard, please.
Yeah, hi guys, morning everybody. So Richard Goldsack, partner at Clearwater in Leeds. I guess focused on the mid-market and business services, but with a lot of private equity work. So echo everything Paul and Dan have said. It's been since probably June 20, it's been a whirlwind 15, 16 months. I think we're all busy and continue to be busy, and you don't want that to stop, but you do worry about the impact on our people. I think some of the other themes that maybe haven't been picked up, I think there is increasing optionality for vendors. All routes are open, as we would say, in terms of overseas trade, UK trade, PE. We've talked about kind of dry powder, and I think the IPO market as well, has been open. Question how long it'll stay open for, but so I think there's a great there's multiple options for people, and that can drive valuation as well. And I think Brexit's probably helped in some respects in that, and I think particularly US buyers are seeing it as a more certain environment here. Clearly we lived through the probably uncertainty of Brexit, but I think at a macro level, if you're making a big investment, at least we know where we are. And I think some other themes we've seen, I guess, that particularly US PE looking at undervalued assets on the market here, which we'll probably come on to in terms of take privates. The emergence of ESG as a theme running across all our deals, along with tech. I would say it's not a tech sector thing. It's now which businesses are using tech as a differentiator. They don't necessarily need to be a tech business. But I completely agree with all the tax and I guess changing of priorities of people. I think that is probably driving a lot of activity in the markets where we all work.
Richard,
and Rich, just picking up on that, do you think?
Go. Sorry, Paul.
I was just going to ask Rich a question there, but do you like us sort of focus on the sort of SME and the mid-market? Sort of business owners are more aware of those options when you're having those sort of discussions, so that you're speaking to sort of more educated business owners, in terms of whether it's equity or
Yeah, I think so. Certainly, PE and trade, I would say there's an increasing awareness of. I think IPO is still an option only for certain types of businesses or size of business, isn't it? But I think the general awareness of mid-market businesses of private equity is increasing, which is probably helpful in terms of dispelling some of the myths of PE and the bad name it sometimes has. So, and I think they're all seeing, transactions close every day in the press, and often getting knocks on the door from both trade and PE. So I think there is an increasing level of sophistication out there amongst our clients. But IPO is only an option for a few, isn't it?
So, Richard, you touched on it in that first answer, that we've seen some take private deals and we've seen some some interesting valuations, I guess. Obviously, the big ones being CD&R's acquisition of Morrison's, and then the Aegean deal as well in Yorkshire. Do you think this trend for take privates will continue, or do you think it's just a finite one?
No, I think it will continue for certain types of business and scale. I think there's probably been a period where UK private equity have found take privates difficult. It's a big contingent risk to take on and a lot of cost without deal certainty. So I think it works at a certain size, and I think the relative valuation differential that the US investors see and why they come and do these take privates is bigger at a scale. So an Aegean type deal is an infrastructure type business, which there are sophisticated pots of capital for. I think a deal size of Morrison's, there is just a value differential and people see that. So I think it will continue to be a trend, but I probably wouldn't expect to see many sub couple $100 million, Ben, if I'm honest, because I think it just doesn't make sense unless you can really get a big shareholder in your pocket, which there are a lot of listed companies who have significant shareholders. So it'd be interesting to get Dan's view whether as a PE house he's running the rule over some. But I think the regulations probably are getting a bit easier in terms of how to actually transact to take private, but it's still not something you take on lightly.
Well, I don't know if Dan's still there or not, but Dan, do you have anything you want to add there?
Yeah, apologies, I don't know if you can hear me okay. There's been a bit technical. But yeah, I mean, I think Rich is right. I think the sort of take that lends it to type. I think you will constantly see the odd deal happen in terms of sort of non-G some specific businesses where investors saw value. So I wasn't one of those. I think from trying to positively, I think it does highlight is benefit of maybe a private equity. I think the ability to different teams to sort of decisions and affect us outside of the content.
I got a bit of that, Dan. But I'm not going to say I got all of it. I'm going to quickly go to Paul and see if he's got a thought on the matter before we.
I think so, and again, it's getting all this because we're largely agreeing with each other, Rich. So we'll have to change that as we go. But joking aside, I agree with Rich. I think for me, actually, it was given the impact on share prices earlier. I personally, I assumed that there would be more activity earlier than there was. Actually, there was probably a view that it might happen quicker, and there were some. Certainly the ones that are more publicised, certainly in this region, Ben, you've raised them, have happened in the recent past. I think to Rich's point, it gets played out in the public domain. A number of houses, certainly in the classic mid-market, haven't historically done it, and I think they've probably started to look at it more actively during the pandemic. But I think going back to our first point, I suspect because deal flows have picked up so significantly. If I say it colloquially, they probably haven't needed to as much as they thought they may have done when everything started. I mean, interesting. We've had a couple of inbounds on potential conversations, in that mid market. But as Rich says, you may have the odd conversation or at least note something may happen, but they invariably don't necessarily always get there. Whereas at the scale and the established businesses that we're talking about, it is obviously a very very viable option, and we all see it play out in the public domain.
So back, hopefully, I think. Let's try and see if we can get you up. You've just muted. There we go.
Hopefully you can hear me. Maybe give it one last go. So it sounds like I'm having a few.
Good man.
Is that better?
Yeah. So right, well, we'll move on then, because the other bit that you've all mentioned is that we've seen increases in valuations, and what is fueling that? Is it the dry powder that investors have, or is it what is changing that? What is changing that view? Perhaps Dan, I'm going to go to you first. What do you think is changing the valuation view? Because I imagine you're not always wanting to pay the premium from the investor point of view. No, I'm just implying it.
This is where we're conflicted, Ben, because when we're selling, clearly we want high valuations, but when we're buying, we want to buy well. So I mean, I think you know, it's undisputable. There's been a general trend upwards on deal valuations over the past few years. I think again, you've sort of had a bit of a perfect storm of QE driving lots and lots of capital and low inflation and low interest rates. So I think the combination of those factors, demand for assets, has pushed up pricing. I think where we sit on that cycle, sort of anyone's guess really. I think, you know, we're probably starting to see inflation bite a little bit now, but I do think valuations will stay strong. The one thing I would say is actually sort of stepping outside of some of the bigger macro factors. I think those businesses where you've got a strong management team and a really clear strategy and strong economic moat, I think they'll always get a premium valuation, almost sort of regardless of where we are in that cycle. So, you know, and I think that, you know, clearly no one wants to overpay for an asset, but sometimes you have to pay the price that business is worth. So I think it's sort of looking at through that lens probably is the way that we're assessing the market, as opposed to worry too much about the sort of broader picture.
Fair enough. And I guess, Paul, you touched on it as well in your intro. You know, where do you see those valuations going, and do you see it in any particular sectors that are really booming, perhaps?
Yeah, dangerous question, Ben. You're asking a lawyer to talk about numbers, but I'll do my best. So, as Dan and Rich are chuckling on screen. So, yeah, I mean, I think the level of valuations, and obviously seeing some of the transactions that have gone through, are probably changing where people thought historic valuations were sitting. And you're hearing someone say, well, you know, I've seen something go for 20 times EBITDA and people nearly fall off the chair. And then you're hearing of things going for 30 plus times EBITDA and more. And people are saying, well, I'm not quite sure our original position on valuation and what the market delivers is correct anymore. So I know investors who are sat back just almost realize, I don't think changing their view of the world, but just sitting back and saying, are we actually getting something wrong here? And has the market really moved on, or is it a Dan's point? Is it a bit of a bubble, particularly in certain spaces? I mean, you know, without naming them all, I think clearly the TMT wider sector, as Dan's flagged, is always kind of strong, and I think particularly, you know, true SaaS businesses. There's a lot of talk, but certainly edtech and medtech businesses, and there's a lot of those examples in Yorkshire. You know, the gaming space has obviously had an incredibly strong run, and there'll be some very well-known businesses in the region. Rich will touch on it better than me, but you know, digital transformation and those type of businesses are incredibly strong, and again, really strong in the region. And you know, e-commerce logistics business as well, which, and obviously with the tech angles to them, have traded very well. So, and we'll come on to it later, Ben. I don't necessarily see those trends changing in the short term. I think the challenge for Rich when he's trying to sell the business, and Dan was when he's trying to invest in the business, is what's the COVID impact, and what's the sustainable position, which has caused people quite a challenge in the last 6 or 12 months to work out. We've had real spikes in you know, performance in a lot of those businesses, and actually where's the true underlying profit.
Yeah, I think there's a term out there now, isn't there, of kind of conviction investor, which we've seen emerge, Ben, and I think, you know, anybody can be a conviction investor if they really understand the business, a sector, and actually get excited about it. So it's not a new thing. We've always tried to find that type of investor on a deal, but I think what we're seeing is, you know, funds and individuals just getting real conviction about things and wanting to do things, and they are doing a lot more research and work into sectors in the background to make that happen. So I think that is driving multiples from a PE perspective. I do think trade are getting a bit savvier as well, in terms of, you know, they've been getting outbid by PE routinely over the last few years, and I think they're all starting to wise up a bit and go, right, we've got investors, if we're listed, saying, what are you doing with your capital? We need to buy businesses, and we need to, you know, often actually engage with advisors to tell us how to play in a process, because, you know, they are now having to compete in a competitive process with people like Dan, who can move very quickly. So I think there is that trend as well. You know, as Paul said, I think the great thing about working in Yorkshire is there is some, you know, some of the sectors that we see in Yorkshire is probably famous for, isn't it? You know, I think we've all worked in and around kind of digital, and that imbalance of supply and demand. Businesses have got probably 5 to 10 years of investment to catch up on to go online, you know, and that has happened overnight, and they're all now having to invest. So I think there's a real long-term opportunity for the Yorkshire region to benefit from that. As Paul said, health tech is a, you know, real strong point for Yorkshire, as is gaming. So yeah, I think some of the real hot sectors actually are, Yorkshire's really well placed to benefit from.
Dan, I could see you nodding, so I'm going to say, what ones are you particularly getting excited about? Obviously, as much as you can say.
Yeah, I mean, I do think we are lucky. I think we've got some really, really strong businesses in the right types of sectors. So whether it is digital economy, digital transformation, digital support services, you have to look at some of the work that's been done right across sort of Leeds region around that market. I think we're quite excited by that. I think there's some really great businesses who are kind of going through some sort of some strong growth and got some real market tailwinds. So I agree with Rich. I think that will be a focus for us. We had a phenomenal success story with Team 17. Video games is a almost out with the economy, is just a really, really unique sector where there is almost unlimited demand at the moment. But you then look at sort of more support services type businesses. So we invested in Mosaic, which is an outsourced provider. I think there's lots of businesses looking at where they can outsource services to providers who are maybe taking a slightly different approach, whether that's using technology or delivering a service. So again, I think those types of business models will always attract investment attention. But Yorkshire's always been strong in traditional industries as well. So whether it's sort of food and manufacturing, so I think we are quite blessed that we sort of touch all parts of the economy, and there are lots of pockets of growth for investors to look for, really. So I'm not going to talk you through the whole whip list, Ben, but I think there's lots to be excited about. It's probably all I'm prepared to say at this moment.
Well, fair enough. Well, you touched on it there that obviously Yorkshire's got quite a strong traditional manufacturing base, and I think it would be remiss as we're having this conversation today in the shadow of COP26 not to therefore have a brief talk of ESG. Now, I was sat with someone yesterday who works with or runs a clean fuel company who did say the words, all investors now are ESG investors, and we've seen that seem to rise up the ranks of what people are considering. I'm not going to say you might have been biased to make that statement, but it is the sector he works in. How much do you guys agree with that the rising importance of ESG, and how is it impacting all levels of the deals market? Who wants to go first? I'm going to just let it open.
Yeah, I'm happy to take it. I think it's a bit like, we see it a bit like technology. It's not a vertical sector. It's kind of horizontal, and it goes across all businesses. So I think it will be clearly Dan and other investors are measured now to some extent on ESG, as are the banks and the lenders. So I think it can help drive multiple to the extent that you can prove that you have a sustainable ESG differentiator. But I think almost any business has to have a strategy around it. And I think if you go out looking for investment or a sale, that you will get questioned on it by investors or trade. So I think it's definitely something we all have to address. And I'd say you can't make it up, you can't bluff it. People see through it. So I think it's got to be real and genuine. But we see in the emergence of B Corp, as a thing, and obviously private equity can get comfortable with kind of B Corp businesses. So I think it's just an emerging trend that will continue, Ben, into the future, and we all need to be conscious of it when we're thinking about how to position a business.
Yeah, I agree with that, Rich. I think it's you've got to be very, very careful not to be flippant around this, because it's you can't be sort of seen to be greenwashing things. But it's got to be authentic. But I think it's probably at the front of everyone's mind. It's right that we as investors are looking to invest responsibly, because one, it will ultimately feed into the future value of the business. So from a day job, you need to look at that, but actually it's more important because it is a shared responsibility. So I think ESG will continue to be a big factor in lots of people's decision making. But that's a positive. We saw that both Paul's team and Richard's team were involved in a business that we sold earlier this year, a business called Sigmat, which was an off-site manufacturer, and it was that business's ESG credentials, its ability to reduce the carbon footprint of a build, which really got the trade population really excited about it. And that was because it was a genuinely disruptive manufacturing business that could prove out those credentials. So it comes back to, yes, it's important, but yes, it's got to be real, and it's got to be authentic, and you've got to be able to sort of prove that. But if you can, that also drives value. So it's a sort of win-win for everybody, really. both for the environment, but also, from sort of business owners and investors' perspective.
Yeah, and Ben, to add to that, I, again, agree with the guys. I think, and it's far more than purely a tick box that, now, and if I'm looking at the deal per se, there's questions on the way in and it's reviewed on the way in. It's then evolved through the documentation to ensure it's covered, and then post, it's then, well, how are we actually going to develop this? And to Dan's point, grow and put this business in a better place for, ahead of an ultimate transaction. And I've seen a number of deals in the last 12 months where sat in management meetings where the management have pointedly asked the potential investors, what is your agenda? What is your plan? Have you got a team? How are you approaching this? And that has been a differentiator or a key metric in said management team or said company deciding to go with that investor or with that trade buyer. Now, I'm not saying that didn't happen 3 or 4 years ago, but I don't think it was at least on the list of key questions to get to the bottom. Obviously, value and terms and deliverability drive a lot of what the three of us do, but all that, and you've only got to see what's been happening, as you've said, in Glasgow, and the weight of support and drive behind that, and the focus it gets, that's only going to evolve. And obviously I won't go through all the areas, but ESG covers a multitude of different things that is very live in the press, and that is continuing to move in the right direction, which is ultimately, and it works in tandem with great transactions, so it's kind of win-win for everyone.
It's a good point around management asking about it. It's almost like, where they want to understand your creds in a particular sector and businesses you've worked with before, but it is, for an increasing amount of our clients, it is a really important piece they want to understand if they're going to work with a particular investor. So Paul's right, it's kind of, you need an articulate strategy on, as an investor, how you're approaching it.
And sorry, Ben, to add to that, Rich, we get, when we're presenting to potential businesses, we get asked the question.
Yeah, pitches.
What have you done? Have you got a team? How are you evolving it? What's your firm doing globally? Again, they were probably on people's minds 3 years ago, Rich, but I don't think I get asked the direct question. Whereas now it's very much part of the presentation to the advisory group as well as the investor. And
having COP in Glasgow is only going to increase it, isn't it?
Yeah,
it's on the doorstep.
Yeah. Well, it does feel it's one of those things that has come out of COVID, is everyone's got that slightly more awareness of the climate, not least because you had those months where there was nothing in the sky and therefore everything looks that little bit bluer. But I guess, Dan, how important is it when you're thinking about, as you said, you want to buy at a fair price and sell at a good price is ultimately what you're after doing with the investment. How important is it when you're thinking about it for the business, when you're going in with that acquisition to acquire it? Because surely it can be a proper market differentiator if you can prove you're a green business or you're carbon neutral or however we want to refer to it.
I think it's exactly as you've outlined there, Ben. You've got to be very alive to it because it's the way that everybody's now focusing. It's just, as I sort of come back to, it's a bigger picture than just what's happening in investment markets. I think it's a shared responsibility for everyone to sort of look that way. So the rate of change in the last few years is, some of the issues we're now talking about, we perhaps didn't. You roll that forward the next 3 or 4 years, so you've got to be very, very mindful to it. But I think the best management teams, the best businesses already have it on their agenda. So again, it becomes slightly self-fulfilling because we're asking the questions on the way in, but for those businesses we want to back have probably already sort of done the thinking around that, and maybe they want some support, or they want some additional views, but they've already got it on their own board agenda. So look, it's I think it's just something we've all got to be mindful of, and it just forms another facet of our decision-making process when we're looking to invest.
So taking out ESG from this question then, because I feel we've covered that one, but as Paul said at the start, there's some dry powder about, and what is it that the investors are looking for now, and has it changed, or is it still the same as it was back in 2019, those glory days of before the pandemic? Now, Dan, I'll go to you first, then I'll go to Paul, then I'll go to Richard, and we'll work our way down and try and think of different things. Dan first.
Yeah. Well, I'm probably going to be a little bit boring. I think the fundamentals probably haven't changed. So I come back to what do we look for as we're going through an investment decision process? We want to know we've got a strong management team where we've got alignment. That's first and foremost for us. you want to know that there's clarity around their strategy and their vision, both in terms of what they think they can do as a management team, but also where they want support from an investor. Because we want to provide more than just capital. We want to provide some value add, and I think ensuring you've got that alignment. I think then from a pure valuation perspective, quality of earnings. So what visibility of earnings does a business have? Does it really understand where it makes its profit? Does it have that level of recurring underpin? And does the business have a clear economic moat? Does it have a genuine USP? So all of those basic principles of investing, I think, still hold true. I think perhaps what we have seen in investing world is actually being more alive to actually you can hit all those factors in perhaps industries that maybe weren't once upon a time lend themselves to private equity investment. So more people type businesses or asset light businesses. I think that's probably the bit that has changed quite rapidly over the last few years. So kind of moving away from something which feels tangible into something which is a bit more intangible, but where actually that value is wrapped up in perhaps the people or the culture of a business. And I think that's perhaps the one change that I've seen over the last 2, 3, 4 years. Rich, I don't know if that's sort of consistent with what you're seeing. You obviously speak to lots and lots of other investors. So
yeah, I think, I know you're going to go to Paul next, but I'll jump in, then it's harder for Paul to think different. But I think so, Dan. I guess the things I'd add is kind of what really differentiates you. Are you a disruptor? Get into the nub of what is your USP? But I think also there's a bit of for the investor, they need to feel like there's a reason why they win it, if that makes sense. So turning on its head almost, I think you've got to give the investor a reason to when they're paying conviction prices and multiples to make them feel like they've got comfortable being the right investor, so they've got a view on it. So I think that that needs to come into account. I think the buy and build, again, it's a bit like if you go back 5 years, there was buy and build was a theme, a bit like a sector where everybody people try and differentiate and say I'm a buy and build house. Now everybody does buy and build, and I think having a really credible strategy as a business on an acquisition strategy will differentiate you in the eyes of investors. But I think they definitely echo all of what Dan said. It's not changed that much, but I think it's standing out from a crowd, great management team, clear growth plan, and I think part of that being acquisitions will help.
And Paul,
yeah, I suppose, and I'll get my own back, so I'll ask Rich and Dan a question. But I think for me, I agree. I think the fundamentals haven't changed a lot. I think the market activity and how much has happened and is happening is obviously largely positive. But particularly to ask Dan the question, I think the focus for investors on which deals to go after and which deals to spend time on, as well as trying to work out early on if you've got a differentiator to, with a connection or trying to deliver on a transaction. So I'm hearing in the market and from your world, Rich, a lot where people are saying, actually, we'd normally have 20 people very interested in this, but actually we've got 7. Now, that doesn't mean this is a bad business, but certain people have counted themselves out because they don't feel they have an angle, and certain people have counted themselves out because they're already looking at 4 or 5 other things and they don't have the bandwidth to spread time. So it's a really bad word, but I always say it's a frothy market. I think the froth at the moment is as frothy as it's ever been because there's just real extremes. And I think we've done it, and I know Rich and Dan have. People I think have spent more time investing in that lead generation corp dev role, so to speak, in their firms to be honest, Ben, to try and get them to the door early and get them in front of management teams early. Because if you're last in or you get an opportunity, unless you've got a real differentiator, which I'm sure the guys can touch on, it's difficult necessarily to find an angle to win the mandate. I think it's my feel anyway from the legal side.
Yeah, and I think we said it earlier, didn't we? There's been a catch-up period of investment, I think, hasn't there, where March to August last year there was a kind of 6-month hiatus. So I think partly what's driven the last 12 months has been that everyone playing a bit of catch-up and getting capital out the door. I think that will change, and therefore people are being more selective. So you can't just run a wide auction and expect everyone to engage. You've got to give people a reason to invest time in a process. So I think the froth's coming out of a bit in that sense. That would be my, I'd love to say it'll continue forever, but I think we've had a bizarre period where there was 6 months where nobody was investing, So that drove the last 12 months, I think, being doubly busy.
Yeah. So, I mean, I think from our perspective, I suppose uniqueness of our ownership, capital will never be an issue for us. It's never a point so we deployed our money and therefore we're not interested. But I think to your point, Paul, it's actually has been a lot of businesses coming to market, and it's where you deploy your own sort of resource and your own efforts, because I think you do want to feel like clearly, competing in process is part of investing, but you want to feel like you've got a genuine angle or relationship with the people you're investing alongside. So it's just finding that balance, I think, between sort of being involved in processes. You're never going to win them all, but also feeling you've got some conviction behind the deal, not just from an understanding of the market, but from understanding of the people you're investing in. And I think that's the balance for you guys, isn't it, to try and get that right level of exposure, but ultimately get the right outcome for your clients.
So you've all touched on it, and we are approaching that sort of the final furlong of our webinar. But looking ahead into 2022, what do you think is going to drive the market moving forward? Is it going to be traditional consolidation-driven M&A, or is it going to be a land grab for those businesses that perhaps have shot up into public consciousness and have become to be viewed as essential? You touched on a few of those sectors earlier, Dan, whether it was the industrial and logistics areas and the tech-driven elements. What do you think is going to drive the market into 2022? Anyone? We'll go the opposite way this time. We'll let Paul go first, and then work our way back. So, Paul.
Yeah, but I think those underlying sectors we've talked about and the growth in those areas, I don't think, if I look 6 to 12 months, I'm not going to go too racy. I don't think those underlying drivers are going to change. I do agree with Dan, and also financial services sector, also another area where there's been a lot of activity, and again some well publicised local ones have happened recently. So I think that will continue. As the guys know, and hopefully I'm glass half full for a lawyer, but my nervousness is the wrong phrase. To Richie's point, I think there's a concentration around your people and ensuring people have appropriate breaks and a bit of downtime, which has been quite a big challenge, frankly, for the last 15 or 16 months. And I don't think that, and again, the latest stats out today were deal flows again up a quarter, I think, from Q3 last year. I think, I'm not saying the bubble will burst. I think the general level of activity will eventually slow. I think it's inevitable it will do. But I think if we sat here again in 12 months' time, hopefully I haven't got this prediction wrong. I think it's set fair for a period of time, and largely focused on the sectors we've focused on today, I think.
Yeah. I think corporate financiers are always eternally optimistic. So I'm not going to talk the next 12 months down. I think some of the things that are driving it, I think that buy and build theme, if you take that up through the market, there's a lot of serious big PE money backing consolidators across the markets. And I think that is making trade buyers, if you like, much more sophisticated, because a lot of them are big PE backed. So I think that'll carry on being a theme. Overseas buyers, we'd probably say the Asian markets have been quiet. If you look at Chinese and Japanese, whether that money might come back in and really compete with the US, not sure. I think the tax point that Paul mentioned, it is a concern for a lot of entrepreneurs we speak to still, the 20% CGT rate. So I think people will probably want to get out ahead of that as well. So yeah, it feels like it'll be a busy 6-12 months, but the volumes can't stay this high forever either, unless a new, maybe they take privates emerge as a real volume play or something. There's got to be something else coming to replace it. But yeah, I think it'll be. But I think PE are probably, a lot of them have probably invested. They've got deals out. They've been playing a really frothy market, and I think that flight to quality will probably become even more intense, because I think a lot of them have probably almost been in a world of we need to deploy capital, and they've done it now. So I think they'll become more selective.
And Dan, to you.
Yeah, look, I'm optimistic as well. I think for us, I come back to capital is an issue. We've got 1.2 billion to invest over the next 3 years as an organisation. So, and I do think we are lucky. We've got lots of really interesting businesses with impressive leaders and resilient business models. So I think the deal flow will be there. think the guys are right. I think, whether it can quite maintain what it has over the last 12 months, but if I was a business owner, I'd still have lots of conviction about bringing a business to market, because I think the appetite will be there, and we're certainly ready to support businesses. So look, I think there's still lots and lots to be really optimistic about as we look ahead.
So 2 final questions then, and if you can each give me one answer to this first one. What would be your first tip for any businesses looking to bring it to market now, to help them get the best value and the best partner moving forward? We'll start with, we're going to do it in reverse again, so we'll go Dan, Richard, Paul. So Dan,
come and speak to LDC first. No.
I feel I've got to do a BBC disclaimer there and say something that other PEs
I'm just joking. I think it's really understanding what is your USP or what is your differentiator. I think if you can articulate that to both the advisors you're working with and the investors, that's the way you get somebody excited about supporting you. So I think it's probably that, if I had to pick one thing.
Perfect. Richard?
Yeah, I'll probably say 2, if I may. I'd say be clear on what you want to achieve from a transaction, which may need some, consultation with advisors on, and then just, kind of, it sounds self-serving, but appoint early and do your prep. I think don't rush into it. So give a good runway. They'd be my 2.
And Paul?
Yeah, thanks, Rich. Your second one's Nick. Mine. I was good. Well, clearly, I was going to say appoint the right lawyer advisor and go with the correct investor. And there's obviously a good, no comment on the people on the call. But I think take time, understand. We'll work with entrepreneurs regularly. Everyone has slightly different things that concern them and slightly different things they'd like from a transaction. So try and get that mindset clear before you start. And Rich raised it earlier. There's a number of routes. Private equity trade, IPO, trying to assess those at the start, and it may change as you go through. But if you have a view on what you're trying to achieve in a period in which you're trying to achieve it, that's a good place to begin.
The very final question, because I need a little bit of conflict. What's going to be the biggest challenge of 2022 within the market? Because it can't all be roses. It just can't. I'm not that optimistic, guys. So we'll go top to bottom again this time. So Paul.
Okay. We may all end up saying this. I think that it's been mentioned a couple of times. I think that the people challenge across all of our industries is as intense at the moment has been, and that's accounting, investor, lawyer, etc. There's a talent war and all those phrases we're hearing out there. And I think that is, and that's both from keeping your internal team kind of, incentivized and keeping everyone going because there hasn't been a break, but also the level of opportunity out there, and the fact that particularly for Yorkshire businesses, there is a number of roles coming up that you would say are traditionally roles from further south, but because of the world we've lived in for the last 18 months, they can be done from God's own county. So those challenges are, and as I say, people have slightly realigned their focus and their direction, and that sometimes means they take a different choice, a different path. So I think the people side is key for everyone, frankly.
I'm going to ignore the God's own county remark as a proud Lancastrian, but Richard.
I had to get it in.
Yeah. Look, I think the macro environment, I think, will get a bit gloomier. I don't think it's going to get negative overnight, but I think inflation is a theme across supply chains, interest rate concerns. I think you'll start to see our restructuring friends have been very quiet, right, in terms of the government bailing businesses out. I think there will start to be actually some fairly high profile failures. So all of that starts hitting the press. It breeds negativity, which is the worst thing in terms of confidence in our market to get M&A done. So I think that it will become a challenge, not in the next 3 months, but I'd be amazed if not in the next 12 months. So I think we've all just got to, see through that and see that the fundamentals are still strong. But I think there will be some headwinds, if you like, coming, as you like to report on the bad news, Ben. I think that we've got to stop those headlines kind of getting in the way of doing deals.
It's a careful balance. It is a careful balance. And Dan?
Yeah, I hate to end on a negative. I share some of Richard's concerns. There are genuine challenges. So you're seeing it across supply chains. It's causing disruption. You're seeing this sort of strange dynamic of labour shortages, but you've also got a big pool of labour coming off the end of the furlough scheme, and quite how that plays through is probably slightly difficult to tell. But I do think that might need some businesses to relook at the capital structure and the balance sheet. So again, whether that drives opportunity or drives challenge, you know, it depends on how resilient and sort of forward looking the management teams are. But I think there will be headwinds, but I sort of come back to, I think there is enough positives out there outweighing some of those, so we shouldn't sort of get all doom and gloom. To try and end positively, Ben. As much as you know what?
I was going to say that was the perfect positive ending to wrapping that up. So, firstly, thank you to all our panelists. Thank you for tuning in, and thank you to Clearwater for sponsoring this session. There will be a full write-up of this available on thebusinessdesk.com in the coming weeks, as well as a video made available. So, thank you very much, and I hope you all have a fantastic day. Thank you very much, everyone.